delighted to be joined by David Bellingham, CEO of Black Swan Capital, who will be discussing investing principles and themes for US expats in 2023. Black Swan Capital is an award-winning independent advisory firm dedicated to delivering investment advice for the specific and unique needs of international citizens. Based in the Netherlands, David has over 25 years of experience in investment advice, having started his career at ING. Thank you very much for joining us, David. How are you today?
Thanks very much. It's a pleasure to be with you today, and thanks for inviting me, Hugo.
So before I hand over to David, please bear in mind that the information presented is for general educational purposes only, and you should always seek your own personalized financial advice. David will be answering your questions at the end, so please add them to the Q&A pop-up at the foot of your screen as and when you think of them, and we'll try to answer them all at the end. So without further ado, over to you, David.
Thank you very much. I'm going to share my screen to start with. I have a presentation to share with you, and we'll go through that. And as you say, if you have any, please ask them, write them down, and we'll deal and address them at the end. And I'm delighted that you started off with that disclaimer, because I have the same disclaimer here. You know, that we hope that you find it relevant, interesting, and applicable for you, but please don't act just on what we've said. What is right for one person isn't necessarily right for the next. So please do go and get specific advice for yourself from the appropriate and relevant professional in doing so. I'll tell you a little bit about us, and then a roadmap of what we're going to go through in the next 45 minutes, hour or so, and leaving room for questions as well at the end. So as you introduced us, we're based here in Amsterdam, but we work right across the EU. We have clients across most countries in the EU where we are regulated and licensed. We have an independent investment firm license here and are overseen by the Dutch Central Bank. We have clients from a number of countries around the world, specifically, and the most of our clients are from the US, US citizens or are US connected individuals. That's the largest group that we work with, and indeed a degree of our expertise and experience we have in that segment. As you all well know, it's complicated, or it can be complex. So we do a lot of work in that space. I'm a part of the team here at Black Swan Capital, and I'll be the one speaking with you today. We're going to talk about two main things. The first one is principles of investment management, and this is in a general sense, but also specific to someone who is US connected or a US citizen. And the second aspect of that is applying some of that to where we find ourselves today. 2023, the year that we've just been through, the years that we've just been through, some of the challenges and some of the opportunities that exist, and how we approach those, and how we would look at those, particularly if you're a US connected international or living in the EU right now. So let's talk about some fundamental principles, and I'll just make the caveat or the comment at the top that I expect that for some of you this may be new, for some of you it may be information you know already. I'll try and move forward at a pace that works for everybody, covering some of the base principles that we can apply. The first thing I wanted to talk about is risk and return, particularly when we've come out of volatile markets, or like we're still in at the moment, really, but typically years like last year. It's worth just realigning ourselves to this, that there is a direct relationship, a positive correlation, if you want to use technical speak, between risk and return. That means that for any given period of time, there is a relationship between risk and return. The higher potential return for a period of time, the higher potential risk. So at the bottom end of it, with cash, you know, ignoring and removing institutional failure risk, the risk of a loss in cash is quite low. In some cases, it is zero. It is quite low. And the opportunity for return is similarly quite low. At the other end, or towards the upper end of the scale, when we're looking at property, more so shares, stocks, other alternate assets, at any one period of time, you can have a potentially quite a good return, but you can have potentially quite a high loss in that same period of time. And it's worth just understanding that. It leads us to, I think, two principles that we'll get into more detail on in terms of this. And one is time and the moderating function of time. And the second is diversification or portfolio construction, that is blending different types of assets together. When we get down track, we'll look at applying this to you being an American in or a US connected person in Europe as well. So look at time first of all. Quite like this chart comes from JP Morgan from their latest Q4 report, and the data captures information from 1950 through to 2021, so a nice period of time. And they're looking at the ranges of returns over different periods of time. The green represents shares, stocks, if you like, stock market listed investments. The blue is bonds or fixed interest, government bonds. And the gray one, which we'll talk about later, is a 50-50 combination, half of each. We can even take it back to a shorter period of time. If you're looking at stock investments, generally speaking, investing in a stock market and buying any particular stock on a stock market, the risk of a negative result in one day is something like 48%. 52% likelihood of a gain, 48% likelihood of a loss by a stock on a stock market. That's the tested results. What they're showing here on any rolling 1 year period since 1950, the investment return can range from, for shares, positive 47% all the way down to minus 39%. That's quite a range. And if you've been in the stock market for a shorter period of time, you may, or invested more diversified, but in growth focused investments, you might see this or something similar, quite a range in potential returns. The slightly lower risk portfolios of bonds show a lower loss potential and a slightly lower gain opportunity. Looking at the stocks on the green, that range, comparing the 1 year rolling to a 5 year rolling, if you look at the average, any 5 year period, the potential return is reduced, but that potential loss is also really reduced down to -3. Over a 10 year period, it's down to -1. And over a 20 year rolling period, any 20 year rolling period starting from 1950, the lowest return in that period has been 6%. What that says here is statistically across that period of time, it hasn't been possible to lose money by investing in equities over a 20-year period. What it's really saying is the risk of loss is really substantially reduced over time. So staying in an investment longer reduces the risk. And that's a rather simplistic view, of course, because it depends on what you're holding and how that individual stock or that basket of stocks is performing. But it shows that it's the same for government bonds. Whilst the range is narrow, the potential for negative returns disappears altogether. Quite simply, when the grey bars are shown at that 50% range, 50% equities, 50% fixed interest, it diversifies and reduces the risk across the period. So the risk of loss at any period of time evaporates after 5 years rolling, which is quite significant in terms of reducing that downside potential. So that's the reduction by time, and looking at that 50-50 leads us into this next position of diversification, which basically means spreading your risk and not putting all your eggs in one basket, if you like. And one way of looking at that is to say, well, what's your comfort level? We're getting that balance right. We call it the sleep at night test. You want to be able to sleep at night, not worrying that you've taken on too much risk or volatility in an investment and you're worried about losing assets or losing value. Or you're worried because you haven't taken on sufficient risk and you're not getting the returns you would like to get. So what is right for one person is not right for the next, but across a spectrum here, and you can see just if looking at the different color proportions, you can see there's different makeups of a portfolio that might actually work for you. I'm going to go right to the middle here, and this is a balanced investor. And basically what it shows, if green is equities again, about half of a portfolio is in growth focused assets like equities, and about half is in defensive. So blue is fixed interest or bonds, government bonds, corporate bonds, and I'll talk a bit more about those as we go through. and a little bit in red, which is cash, and then some other alternate assets, which might be defensive assets to reduce volatility and risk. The idea being that by spreading it across different types of investments, you'll have a reduced volatility, reduced chance of negative returns. Stocks and shares, I presume we know what they are. They're buying a share, a proportion of a company that's listed on a stock exchange, and you can have dividend income from those. You can have capital growth. The value can go up and down. The company can go broke, and you can lose your investment, of course. Bonds is when you're lending money, typically to a government, you're lending, or to a company, a big company as well. They will raise money this way, and you'll get a return on this money over time. It's usually considered safer because they have an obligation to pay you back, unless, of course, they cannot. And you may have heard in the past of countries defaulting on their debt. We heard this after the last major financial downturn in 2008, 2009, through to 2014, 15, and there was talk of countries like Portugal, Italy, Ireland, Spain, and Greece. It was called pigs at the time, the different countries that were at risk of defaulting. In effect, though, there's only been, or reputedly only been, 6 countries that have never defaulted on their debt, that is, refused or been unable to make payments. It's a list you perhaps might not expect. It includes New Zealand, Australia, Thailand, Denmark, Canada, and the US. Notable exceptions there, most European countries, the United Kingdom as well. Most countries these days, most of, I guess, leading countries would be at lower risk of defaulting, but it's not without risk. It's considered a lower investment than shares, but it's a case of, I guess, having a diversified portfolio, following the context that typically when stock markets go up, bonds, fixed interest tends to perform a little less, but when stock markets fall, bond markets will increase and provide some stability. There are exceptions. There's been 3 exceptions in the last 100 years to that. One of them happened to be 2022. So it's probably fresh in many people's memories, and we'll perhaps talk a bit more about that a little later. The concept here, though, is that diversifying can reduce your risk over time. And because I'm using the word risk quite a lot here, it's good to stop and think about what risk actually means, because there's 2 different concepts in the investment world, and one is risk in an absolute sense, and one is volatility. So I've got a graph on the screen here, which is a measure, what they call the VIX index, and the VIX is just the volatility index of investment markets, of stock markets in this case. And basically this is a measure of how much markets move up and down day to day. And you'll see this when you listen to the financial news, and you'll hear about a market that the index is up this much or down that much on a given day. That's the volatility. When you look at your financial reports, the more the 1 year or 3 year return graph looks like a roller coaster ride, the more volatile it is relative to what it does longer term. So volatility is really a change in investment value from one period of time to the next. Another example of that, because, you know, relative to your investments, which might be priced daily, and you can see daily changes, an alternative to that might be a property. If you own your own home, or you own an investment property, and you get a report of a valuation of that periodically, and often once a year, depending on where you live, you'll get a valuation. And it might be that in 2021, you get a valuation on your property and it's worth 500,000 euros. In 2022, it's worth 550,000. In 2023, it's back to 510,000. So you can see the value is changing. For most people, though, it's nice to know, but it doesn't have much of an impact if it's their main home, because it has lots of other impacts for them, lots of other benefits for them, and that doesn't necessarily make them worry because the property is still there and it's still functioning as it should. It's often the case with good investments that their valuation day to day or year to year is not necessarily as important as the long-term function it's striving to achieve. You need to separate that, which is volatility, from risk. Risk is the potential to lose your asset, absolutely. And there is a crossover in as much that an asset, an investment asset that you own, a share, could become worthless. That company could collapse. go into bankruptcy, and then the shares are worth nothing and your value goes down. It can happen from time to time. One of the ways to reduce that risk is diversification, not just holding one stock, avoiding that concentration risk, holding a range of assets so that you're not so exposed to that risk. And it can happen to other assets. And we saw a few examples in the last year with newer assets, like some of the cryptocurrencies that failed in the last year, and their valuations went to from whatever they were at to zero. That is risk, that you're losing a value of your asset. Absolutely. When you're investing in things like derivatives, that can also be the case. The derivatives are things like options. You've got the right to buy or sell an asset at a greater or lesser value in the future. They can reduce to zero. They can reduce to zero, depending on how you're invested in those. So they do require quite a degree of caution. So understanding the difference between volatility and risk, particularly in the markets that we're in, is really important. There are a couple of other areas of importance I want to address now as we're going through these key factors. And the next area I want to talk about is inflation, but more in the context of how we keep, I guess, an eye on inflation relative to managing our assets. I'll address inflation as a 2023 issue in the second half of the presentation. At the moment, though, I want to mention it in this context because inflation, even when it's low, is insidious, and it can creep up and have a pernicious effect on your lifestyle and on your assets and on your life plans, really. And so I want to alert you to the rule of 72 if you don't know this. And this is a really good way to look at how inflation impacts your life. So looking at that first example, if inflation is 3% per annum, which it was not long ago, and it's been a whole lot more just recently, if it were 3% per annum long run, if you divide 72 by that 3%, that gets you 24. And that means your spending power halves in 24 years. That means if you are planning long-term retirement, say, I want to retire in 25 years, and I want to retire on 50,000 euros a year, by taking a 3% inflation into account, you're going to need 100,000, not 50,000, because in 25 years' time, 100,000 is the same as 50,000 today. So that's the impact of inflation. You don't necessarily see it week to week, but over a longer period of time, it can have an impact. The other way of looking at it is to say, well, look, I'm going to have an investment and I'm going to aim for quite a strong return of 9% per annum. That means 72 divided by 9, I'm going to double my money in my investment every 8 years. And we know that investment growth compounds. So you double from 100 to 200, then 200 to 400, 400 to 800, and so forth. So it grows exponentially. So every 8 years, you're going to be doubling your money. That's your expectation. But if inflation is 3% and you're aiming for 9, you're really getting a net of 6% in the middle. So you're really doubling your spending power every 12 years, 72 divided by 6. So that's a really nice rule just to keep in mind, to think, what's my cost of living like in the future? What do I need to think about? What impact does inflation have on my life? And how long will it take for me to grow my money at a given rate of return? So keep the rule of 72 in mind. We'll come back to it in the sense of talking about inflation as we get further down into the presentation. So some implications of being US connected, and depending on which other presentations you've been with in the last day or so with this great conference, you may have heard of some of this already, and you may know about it already. But some general experiential things that we see from clients is that, your money is being refused in the EU, and an institution says, I'm sorry, we won't take your money beyond the bank account because you are US connected. Not because it's illegal, but because it creates a need on that institution to do some rather substantive reporting through their tax office back to the IRS. And if they get it wrong, there's some rather punitive penalties, so it's easier just to say no. So we know that hassle. The second issue, of course, is that if you are holding assets in the US, and like a lot of our clients are at the moment, receiving love letters from those institutions telling them it's time to close down that account, or you just need to freeze it. You can't trade on it anymore. You can't buy, sell, you can only hold. You can sell to close down only. You can't add to it. So there are two hassles that we're seeing. And then once you've managed those, you need to ensure that you are investing in a manner that's compliant with both or all of the US IRS requirements, meeting your FERA and your FBAR reporting obligations, that you are compliant with broader EU regulations and the country of residence tax and other issues that you are needing to comply with here, and anywhere else where you might have a tax obligation or a reporting requirement. Overlaying all of that, you need to make sure you're still aligned to your objectives, because one of the things that we'll talk about towards the end is that the key driver should be for all decisions you're making is what you want to achieve. I mean, our broader philosophy is that this money or investing, it's just a means to an end. If it's numbers on a screen, it's not the end goal. The end goal is actually what are you going to do with that money and how are you going to make that work for you to give you the life that you actually want to achieve. So that's what you're really looking for. So we need to overlay that as well. So a couple of things that you need to do. And firstly is get and stay compliant. And we've been saying this for several years. And 7 or 8 years ago, there were some statistics that came out that said something like up to 90% of US citizens living outside the US were not compliant with FATCA. And that was because it was rather a bit newer then, and the knowledge of what was required wasn't so much there. And we know that that number has improved markedly. But still, ensuring that you're compliant is really important. Getting independent advice, whether that's in the US about tax advice or wherever you're living in Europe, or financial or investment advice, getting the right advice is important. Making sure you're using investments that are US compliant, not because non-US compliance, and you'll hear the term PFIC or passive foreign investment company mentioned a lot, not that they're illegal, because they're not, they're just prohibitively taxed. So they're making it really unattractive for you to be in that investment. And from an investment analysis perspective, it's not really worth pursuing that way. A couple of other things that we think is important on the basis of what's the worst thing that could happen if I don't do the right thing is not to use someone else's US address, to not have someone else manage their money on your behalf. That's just as a personal risk that if anything deteriorates in terms of relationships and so forth, or just thinking you're too small for the IRS to worry about, because we've seen cases where they're not too small. And if you're unlucky enough to be picked up in an audit, to have your things done right gives you a peace of mind that outweighs anything else that could be seen as a benefit. So I think being compliant is a fundamental and first step that you need to do as a US person. The other thing I really wanted to mention was pensions, because this can get rather complicated in the sense that pensions are not the same the world over. They're treated differently. Their own regulations are different. They tend to be nationally regulated, and they have their own rules and requirements in terms of liquidity access, contribution potential, access to capital, and timing of drawdown and so forth, and quite a lot of variance. The US has an excellent pension system, as any US connected person will know, whether you've had a 401k or 457B, whatever you've had, you've got an employer pension of some description. You may have a rollover IRA, you may have a Roth IRA. Their treatment may well be different in different European countries. The access rules are certainly different in the US. You can access 401ks from 59.5 if you stop working, if you want to. There's great access to capital, potentially with some tax advantages in Roth IRAs, because it's after-tax money gone in, or it's considered as such, and therefore after-tax money coming out. So it gives you flexibility in that broader retirement planning of when you stop work, do you want to renovate a kitchen or take a holiday or buy a boat or whatever it might be, and the access to capital can help that. However, managing that when you're an EU resident can become rather complex, because in most European countries, when you're a resident, ignoring some specific tax situations like the 30% ruling in the Netherlands, if you have that for a 5-year period, you are generally taxed on your worldwide income and your worldwide assets. Some countries in the EU, like Germany, tend to consider Roth IRAs, for example, as not being pensions for tax purposes. And that comes down to their classification or definitions of what is a pension by measures of tax access, liquidity, age of access, and so forth, which means that if you're holding a pension asset that's not considered a pension, you're potentially liable to be paying capital gains tax. Now, you need specific advice from a tax advisor in the country you're regarding that. We're certainly not tax advisors, so our caveat is that we're not giving tax advice here. We're being quite clear on that, but you do need to look into these things. And if you do pay tax in Germany on that, that's capital gains tax of up to 25%. It can be treated as income because there's no capital gains tax on investment assets in France, but it might be income. You might be taxed at 30%. The Netherlands, of course, doesn't have capital gains tax, but they do have a wealth tax. And again, you could fall under that 32% wealth tax potentially. And so you need to be careful of how you are managing those assets. And of course, that then makes you consider the attractiveness or otherwise of adding to these investments, because you can add a modest amount to your Roth IRA every year from outside the US if you want to. But you need to think, just because I can, does that mean I should? And consider what's the opportunities versus the liabilities of doing so at the period of time or for the period of time which you're a resident in that European country, and how does that impact your broader retirement goals. In parallel, you should be looking at your local pensions. There's very good pension systems across the EU. They have different ages of access. Germany is increasing their age of access at the moment, as is the Netherlands. France is trying to, but it's still quite a bit younger than other countries. You may have accrued state pension benefits in these countries as well. In some of these countries, you'll have zero access to capital, just income. And so you really need to think about, if I have the opportunity and potentially the tax benefit of adding to these investments, and that can be attractive if they will take you as a US connected individual, because some of your options may feel limited. What's the benefit of that at the other side? And the real question, therefore, is where and when do you plan to retire? Now, I know in experience from a lot of our clients, the answer to those questions is I don't know. And that's quite normal for expats. We see that a lot. If you're moving around and one plan may merge into another, or you may discover a new country that looks more attractive, lower cost of living, or a more aligned quality of life, for example. So you do need to think about that. And if you're living in a country that you have retired to, and your pension assets come from 2 other countries and potentially 2 other currencies, there are potentially 3 tax systems to navigate, 2 currencies to navigate, and a whole lot of complexity. So that can work, but it needs some planning, and you need to be prepared to consider that at the time the decisions are being made around where you place your money. So thinking about that long term, not just the current environment, we think is really important. If you can do that, you can leverage the great opportunities that may exist with US and EU pensions, at the same time not causing yourself complexities or disadvantages for your long-term future. Again, it's the end-term objectives that should drive the decisions in the short term. Let's take some of that and look at what's happening this year in markets, and seeing how that applies to some of these things. We're at an interesting point, I think, right at this point in time, and I've listed some observations, some perhaps more negatives than positive, but are creating a balance to our view of the world as we see it right now. January to June last year, as will be fresh in many people's minds, was the worst start to a year on US stock markets, at least since the early 1970s, nearly 50 years. It was a pretty tough and grim point of time in markets. 2022 was also the worst year on bond markets since 1788. Now, that's quite some record. So the confluence of those 2 events created for a rather unattractive financial market for a lot of people in the short term. In one way of describing it, some people said there was nowhere to hide as that was happening. There was a period in around April and May last year where, for a couple of weeks, every single stock on the S&P 500, that's the largest 500 companies on the US stock markets, all fell at the same time. Now, if you're taking a rather analytical view of it, they weren't all submitting poorer financial data, poorer financial outlook on their company's balance sheets or their sales projections. It was market sentiment driving it down, and that sometimes happens in markets. So we've been through a negative period that some of which still surrounds us. We've got factors like geopolitics and war. We're coming up almost to the 1-year anniversary of this awful invasion of Ukraine by Russia. It has obviously the biggest impact being social in people's lives. It also has economic impacts. It has financial impacts on the European economy, as a lot of people learned last year, the role Ukraine plays in providing grains and other export to the rest of the world, that being an impacting factor. Reducing the supply of that had inflationary pressures, which were already strong. So we saw those impacts as well. Inflation is a big issue at the moment. We started talking about that in 2020 when we saw the central banks making what were good decisions at the time in 2020 and early COVID, starting to pump a lot of money into markets to hold the economies up as we all ground to a halt and no one could go to work and supply chains really closed down to keep economies going, to keep companies going and families going. A lot of money was pushed into economies. We knew then, and as most people in finance did, that would have to come out in some other way, manifest in another way, which will either be in the form of taxation or inflation. And it came out in the form of inflation over the last year. And I'll show you some slides on that. But there's a link between that and the Ukraine crisis as well. Currency has been a volatile point this year and the last year, as the central banks are now increasing interest rates. Again, we'll look at the next couple of slides. We're seeing more currency fluctuation. We always believe that currency is something you manage defensively. You don't try to opportunistically manage it because the opportunities for loss can be more profound than any gains. But if you're managing money across currencies, you will have experienced that. This time last year, the US dollar was sitting at about 86 cents to the euro. Last year, through the course of the year, as the US was ahead of other markets in raising interest rates and through some other factors, and at about the same time as the pound crashed, we saw the US dollar go up to 103 to the euro, up over parity, which if someone was coming back this way with money made it very good. If you're sending money to the US, it was very expensive. It's back down to about 92, 93 cents now. And it is sort of trending that way in the long term, but again, not in a straight line. So we're seeing quite a lot of currency volatility that can have an important impact on your income if you're earning across currencies or spending as well. So that's something to consider about. And then, of course, the term everyone's talking about is recession. Is there one? Are we having one? Are we avoiding one? Is it hard, soft, or not at all? And it somewhat depends on how different institutions, banks, and governments define recession, because there's a few different definitions going around. The traditional one is 2 consecutive quarters of economic contraction of a market. By most measures, that and the sort of the more soft, I guess, feel of what's going on in a place, it appears markets like the UK are probably in some form of recession at the moment. There's question about whether the EU, the Eurozone, is or is not, and whether the US will or will not avoid a recession. It's rather dynamic, and if you look at analysts' positions from about October last year, they've gradually softened their views on this over the period of time. It can be linked to, amongst other things, the increasing of interest rates that the central banks are doing to slow down inflation. Recession is a side impact of that, which they're willing to forego, which means everything slows down a bit in the economy, which can have a negative impact on markets materially or sentimentally, meaning that institutional investors will move away from markets because they believe it's going to fall, and perhaps in some ways will make that eventuate. So there are a number of negative factors, and these are risk factors, if you like, against where we're at in 2023, or complications we need to think about. Contrary to that, though, we've got some of the lowest unemployment in 40 years. We've had really sustainable unemployment numbers and job figures. Moderating that somewhat, we've seen, particularly in the tech sector, a number of firms performing layoffs, sacking staff over the last month. It's about October. Analysts will say that quantitatively it's quite low proportions. I'm sure it's material and significant for those that are impacted. Unemployment remains at really low levels. That's rather important in the context of recession, because if unemployment's low, it means there are fewer people claiming unemployment benefits from governments, and it takes the pressure off government spending and it gives them, I guess, more funds for alternate uses. So there's some resilience in the market with unemployment being low. Interest rates that have been rising a lot in last months are still rather low historically. And we'll look at that a bit later on, but that's a positive in a sense that then we're not going to 1990s in interest rates. We're still staying relatively low. The fact that China has been reopening in the last months and improving supply channels is really important. That links back to inflation, because inflation, that increase in cost of living, occurs from one of two levers generally. Either demand is really high, which means we're all going out and buying lots of things, or supply is short. There's not enough of the goods we all want, so the price goes up. If it's demand, when the central banks go and increase interest rates, that has quite an impact on us because it slows the market down. But if it's more supply driven, that shortage, that raising of interest rates doesn't work as effectively. And therefore improving the supply, that international trade and the semi-finished products or the goods coming out of China into other markets in the world, that material supply improving takes pressure off the supply. There's more of it, therefore the prices abate somewhat and inflation can reduce. So that's quite a positive. There are some complications. I didn't put the complication of COVID, the continuation of coronavirus or new strains coming through. That's another factor. Central bank actions at the moment have, I think, are considered a net positive in that they appear to have worked. I might be a little premature in saying that they are, perhaps, working at the moment, and they seem to be slowing down inflation. I mean, there's some graphical representation of that now, which we can show in a couple of slides as well. So there's a few things that are positive and a few things that are negative that are impacting the market where we're at right now, which gives us a fairly cautious position to consider where we think we're going. But really, when we're looking at markets, we're not just looking at what's the next hot thing, what's happening next month. It's really about where are you heading in 5 years, or in the context of your objective. What do you need to change now, and what becomes immaterial to you over that time frame that you can afford to weather? So let's look at inflation first of all. And this is inflation over the last 30 odd years or so, going back to 1991. We can see that broadly inflation was on this lovely drift down. And so for the last, certainly since the last decade or so, inflation hasn't really been an issue for most of us. We've kind of forgotten it exists. It's been sitting around about 2%, and hadn't been material year on year. If you didn't get much of a pay rise, your cost of living didn't increase that much. So it didn't matter as much, until, of course, it started rocketing up last year for the reasons I just mentioned. What's important here is this little dip at the top. So inflation, I guess this is a graphical representation of an analyst saying inflation has peaked. In other words, it's coming off a bit, which means it's growing faster, slower. So prices are going up, but they're not going up as fast as they were a couple of months ago. This is where we get back to the point about central banks saying, well, our raising the interest rates has worked to an extent because we've slowed inflation down. And this is always going to be a spike against that massive influx of money back in 2020 with the early stages of COVID. This was always going to happen. Now it slows down again. The expectation is we get back to low, sort of mid-range inflation in the next couple of years. We can see what's happened with the cash rates. And this is the European Central Bank. And a couple of months ago, Christine Lagarde, who's the head of the European Central Bank, made the statement that, yes, interest rates are rising, but we're still a long way off normal. It's now at 3%, taking into consideration that mid last year, up until July last year, or June last year, the official cash rate in Europe, Eurozone, was minus 0.25%. So we're negative. And negative interest rates, and you can see it had been 11 years since they had increased interest rates until they hit September. And then July and then September, the fastest rises ever. And then they kept rising. The thing of significance, I think, is in January this year, just last couple of weeks, they started slowing down the rates at which they're increasing interest rates, and have said that, yes, we can expect another 0.5% next month, but they're hinting towards a general slowing down of the rate of increase of interest rates. it has a couple of important impacts as an investor generally, and specifically as a US connected person, because we're seeing similar things in the US as well. We can see that they're projecting inflation, which across the Eurozone was 8.1% last year. They're saying it'll get down to 5.5% this year. I think they're scaling that back even further at the moment, and back at around 2.5% to thereabouts next year, which is back in long run average. Now, if you're getting pension income from variable annuities, if you're saving your money, or if you're holding a fixed rate mortgage, you're pretty happy with this increase. For a saver where you were getting negative interest rates on your cash, you are now getting maybe close to positive. Banks are still offering very low rates, but they're no longer taking money off you to hold it. If you hold a fixed rate mortgage from a couple of years ago, you may be feeling a bit smug that you got in at 1 or 2%. But of course, as inflation stays high, your costs relatively feel quite low. If you're a new borrower, though, it's not such good news, because that 20-year fixed mortgage rate of 1.9% a year and a half ago is probably now about 4%. If you're on a variable rate mortgage, you will have seen that go up as well. And if you're a borrower, like a corporate borrower, it's costing you a lot more. If you look at the Fed in the US, you can see their rates, and it's come up. I've shown this over a much longer time frame just to give a bit of context that the Federal Reserve Chairman, Mr. Powell, is saying at the last meeting that they expect this to be one of the last increases they do. The market's even pricing in cuts later this year, which we find rather extraordinary. But in the long run, it's still rather low. And that's what's important to consider, that yes, interest rates are coming up a lot, but they're coming from rather a low base. This has a really important impact, though, when we're looking at your investments. Before I jump to the next slide, when we're back talking about diversified portfolios, areas like the fixed interest can now potentially offer a better return as a component of your portfolio than they used to. So it's giving you more risk-adjusted choice to a portfolio, and that's what the important impact of some of this these rates are, where this means that the US Federal Reserve was offering a 10-year bond rate at under 1% a year ago, is now offering over 3%. So ignoring some of the other secondary market risks, if you're holding it for the duration, that can potentially provide some alternatives to being in equities if that's too risky for an individual. It also impacts the property market. And one of the questions we get asked a lot, particularly from our US clients, is about the benefits or otherwise of investing in real estate. Generally speaking, it's a great asset class. It comes down to where you're buying, how long you intend to hold it for, because whilst it appears safe, and we hear about safe as houses and bricks and mortar, prices can go up and down. We've seen clients make money and lose money in real estate. So it depends on how long you intend to invest in it. Looking at things like, what's the cost of entry? What's the relative cost of renting versus buying? Are you going to pay a lot of tax on the disposal? In some markets like Germany, like France, you may be paying tax on sale of that property, depending on how you hold it and own it. And does that still make it a viable investment for you? How liquid is the market? But then what other benefits does it provide you outside of the financial? Does it give you that psychic income, that security for your family? Because that can become important as well. The flexibility is important. If you move away, do you have to sell it? Are you allowed to hold it and rent it out? Are there costs incurred in doing so? And what's the market valuation? We've got a good reference point that we like to look at every year. The UBS, the big investment bank, do what they call the Global Real Estate Bubble Index. And this came out at the end of September last year. And I'll show it in this way. It's probably easier to see that. They call it, what are the greatest bubble risks? And this was as at last year. And if you just look at Europe, in a really simplified level, are markets undervalued, fair value, or overvalued and at risk of a bubble? Meaning, are they at more risk of potentially falling in value? And of course, each market has a number of other factors impacting it, like supply and so forth. But it's something that's good to be mindful of, that when you're buying a property, are you thinking of it as per any other investment, in which case this sort of information is really important when you're looking at only at return on investment, or are you looking at some of the personal factors as well, because it's somewhere else you can put some money compliantly as a US person, and it's long term, and it gives your family some security and stability whilst you build some capital value in the property over time. So that's something that's an important area not to dismiss, but to consider really carefully. I haven't talked much about stock markets other than what I've done in the last year, in the first half of last year. And this is just a map of the S&P 500 again, the US index, over the last 100 years, just to reinforce a couple of points that markets have a couple of inevitabilities about them. One is when they're going up, they'll eventually go down. When they fall, they will eventually recover, and they go up more than they go down over time. This is kind of what we're illustrating here. The gray vertical bars represent various market crashes and falls over time. That big crash in February, March 2020, which was the fastest fall of over 20% ever, it fell 29% in 3 weeks, is barely a slither line on the graph here because it recovered so quickly. We can see 2008, we can see 2000, and back to 1987 here, of course, as well. The point is markets do go up and down. They did fall a lot last year. They're starting to recover a bit. And depending on your time frame, how you manage that depends on the, I guess, the time frame of your investments and ultimately your objectives, rather than reacting to the dynamics of a market. What's more important, I think, is that we know that markets go up and down. There are more up years than down years, and that manage them to your objectives is the ultimate. This is a really interesting example of what I'm trying to convey here. This came from a webinar I attended just a couple of days ago, put forward by Morningstar, and it was done some back analysis they did going back to 2008, 2009 market crash, which is the biggest, most recent one. And they looked at 3 real life scenarios here of the market crash down to its nadir at the end of 08, 09. And the investor who then said, well, this is no good, as a lot of investors will, and I'll pull my money out and stick it in cash because I'm worried about what's going to happen. And they stay in cash and they grow along fairly steadily, which is the yellow line, versus the investor that says, well, this is similarly, I'm going to just hold on to my money because I'm concerned about the market falls. I'm going to wait for a year and then re-enter the market. And then, of course, they do this in red. And then the third person who didn't change, and they just said, okay, well, this is terrible, but I'll hold on for the long term because I don't need the money for 25 years. The message being that the data shows holding on for the longer term, if you don't need the money and it's not causing you other undue stresses, your returns are likely to be better over the longer term by maintaining the course and not trying to time the market and not jumping out at the bottom. It links to the, I guess, the psychology of investing that we will like this here, in fact, that we can talk about. This is one of the more common investor biases that we talk about quite a lot, and it reflects it here in this graph, which the black line of which reflects an asset, maybe a stock market, maybe an individual asset's price over time. And often when we see a price, and we can the classic example of this is overlaying Tesla. I don't want to use them necessarily as an example, but a stock that comes into favor at a point in time, and people start saying, well, this looks interesting, maybe I should buy some, but waiting for some validation. And now when they can see it's right, they'll say, well, I'm going to buy them now while they're hot. And they're typically buying towards the top of the market. There may be a little dip, so they sell because they're panicked, and then they recover, so they're buying again, effectively buying even higher. As investments go through inevitable cycles, the investor that's bought in like this will often go through this process of saying, resignation of, oh, they'll bounce and I'll wait for them to come back till they get to a point of exasperation where they've exhausted their ability to tolerate that and says, I've had enough, I'm going to sell now. And they sell that near the bottom. Inevitably, the market turns around and other people start saying, this looks interesting. So there's a couple of ways of looking at this. And one way is to think of this in comparison to how we look at assets, or when we go to the shops, go to the supermarket. When we go to the supermarket and we see in the aisle that our favorite bottle of wine is on a 50% discount and it's 1 + 1 free, that price has dropped 50%. We look at that as an opportunity and we buy. If we go to the store and washing powder's doubled in price, we might wait for a week until it's come off in price a bit if they're flexible in the prices like that. But when prices go up, we're less likely to buy. And that's typically how we shop. When it comes to investing, we tend to do the opposite, and it's a natural inclination to do it. And it's quite an unnatural thing to try and fight what we've shown in this graph. And that's what we're trying to suggest here, that to ride the waves, to buy when things are cheap and to hold for the long term. If you're selling something when they're a higher price, makes more sense. I always look for a couple of measures or a couple of voices in markets. And one is when things are falling, when you start seeing in the press, when you inevitably do, people coming out and commentators saying, this time it's different, it's going to fall forever. That gives me a bit of assurance that we must be near the bottom. It's near the bottom that people start saying, this time it's different, it's going to fall forever. At the same time, when markets are rising, and I start hearing this time it's different, valuations don't matter, or you can't value this asset like other assets, or it's going to rise forever, that gives me great cause for concern and great caution, because that suggests exuberance. Markets are always going to follow these trends, and this message of this time it's different, it's going to rise forever, I heard that in 1999 with tech stocks just before the NASDAQ crash in March 2000. We heard it with cryptocurrencies when Bitcoin was approaching 60,000 just over a year ago, and when they were saying it's going to go on forever, of course it didn't, and it's back at around 23 now, having been down to about 14. So we're seeing this sort of trend repeated in asset classes over time, and looking to correct yourself and check yourself against market price movements, and the emotion that goes around investments can actually save you towards your goals and save you from incurring other losses. So some other considerations before we turn over for questions. We'll put them all up together. Firstly, we need to think about compliance. When you're thinking about where you're going to invest, think about compliance. Making sure that it's compliant for the market you're in, but also US compliant, so you're not being punitively penalized through the taxes unnecessarily. Looking at things that may be important to you, like liquidity and flexibility, because I know a frustration that a lot of people have said, US connected people have said, that they want to invest, but they just don't want to be locked away, or they feel frustrated that they may feel they have to. You don't necessarily have to be at all, in fact, but making sure that you're aligned with things like liquidity, meaning you can access the money if you need to. Flexibility, you can change it if you need to, and this is without incurrence of taxes or penalties and exit fees and so forth. Costs and volatility and returns all need to be considered, and not chasing the latest hot thing, which is what this graph on the right shows. There's lots of color on it. It basically shows that what is one year's best performer is often the next year's worst performer, and so on. So that trying to chase last year's best returns will often leave you in the lower half of a performance matrix over time. So don't chase the latest hot topic, and don't follow public figure gurus. That's our general advice, that stick to your objectives. Everything should be objectives based, which is the last point we talk about. Considering the other risks we've mentioned there, like your citizenship being US connected, risks and transferability, that you can move assets between countries if you need to, is important. But fundamentally, the last point is the most important one, and sticking to your goals and your objectives should be the key driver of everything when you're managing your money. So a couple of basic, I'm going to jump this, because I'm running short on time, and talk about the 7 questions we ask. And are you US compliant? Making sure your investments are aligned to your objectives, that they help you to get to where you want to go. So you do adjust them to we've talked about a lot about long-term focus and not chopping and changing, but you do need to adjust to markets over time. The top 10 performers that made up the top of the Dow Jones in 1970 are quite different from now, and many of them don't exist as they did then. So you do need to make adjustments over time. Making sure you're compliant, that performance is relative to your goals and risk profile. So you're not necessarily, depending on who you are, chasing the maximum returns. You're chasing enough. You're chasing what is enough for you and what you need to get to. So it might be the lowest risk you need to take to get you to your goals, depending on your situation. Making sure you've accounted for short-term needs for cash, making sure that your assets don't keep you awake at night, and that you look at it in the time frame like you look at other less liquid assets. They're really, I think, important guiding principles you need to consider when managing your assets and investments. What we'd like to do now is turn it over to questions, and I think we're going to get some help from Hugo here with that. We have a number of resources on our website, if you'd like, to check those out at blackswancapital.eu. There is a US guide there you can download, as well as some other more generic guides. Lots of a couple of videos, lots of articles and things you can read as well. So you can contact us directly for those. But we'll turn it over now for questions. And I'll stop sharing my screen so you don't have to look at those the PowerPoints. And we can see.
Yeah, thank you very much, David. That was excellent. A lot of information there, and I think that point about not sort of following the tailwinds and following the trends, but keeping focused on your long-term objectives is powerful advice in what can seem like volatile times. So let's jump into some questions. How do you know an investment in Germany, for example, would be compliant with US tax requirements? For example, I've heard you should not purchase a German mutual fund.
Right. That's a good general point, and I'll avoid getting into specifics. But there's a general sense that most mutual funds, which are approved, regulated in the EU, are by default considered PFICs, passive foreign investment companies, under the IRS's definitions, which means you may end up paying punitive tax. Best way is to check. You can check whether they are or not. There are Euro, that is EU, generally, German specific in your case, and US compliant investments that have all the same attributes of liquidity, flexibility, and so forth you can access. It's just a matter of getting the right advice or getting pointed in the right direction. So I'm going to avoid giving specific advice here because it's not the forum. Happy to speak offline about that, but there are ones there. But if in doubt, go and ask and go and check, because it's better than being caught out a year later when you're doing your tax return and end up paying more tax than you need to.
That's great. And I think there's a similar question. So is there a compliant way to invest in something like index funds while living in the EU? Or is there some equivalent for something in the EU who may return to the US for retirement?
There are equivalents in the EU, and again, there's quite a range of them. So I always describe it this way: there are a universe of invest options for residents of the EU. That universe is shrunk somewhat to that available for less connected individuals. It still exists. There are still a range of options and a sufficient options to meet just about everybody's needs in the EU. It's just a matter of, as I say, getting pointed in the right direction. It doesn't have to be any more expensive than doing it otherwise. You can have active, passive, or a combination of. And again, we can point people in the right directions as to how they go about those if they need to. And the second part of that question was about moving back to the US?
So, yeah, for somebody who may return to the US to retire, where would, and I think wanting to still invest in index funds, what would be the best scenario?
Yeah, right. And there's a whole range of, I guess, aspects to that about whether they're within or without pension systems, currency, because you can be in the EU, invest compliantly here from a US and EU perspective, and invest in USD if that's what's right for you, avoiding currency risk. Depending on how you invest, you may also be able to then facilitate some sort of an in-specie transfer, which means you're not even having to sell and buy assets again. It depends on the individual and the circumstance. But yeah, there should always be that flexibility, whether you keep that asset here or move it back to the US when you retire. You can certainly do that. We've had clients move back to the US and move their assets back there.
That's great. Okay, here's one. For a US connected retiree living on private pension, government pension, personal investments, being stocks and bonds, and I assume all those are coming from the US. Generally speaking, which two Euro countries have the most favorable overall tax regime, taking into account tax treaties, and which two Euro countries are the most prohibitive for retiring, I guess, with US income?
Yeah, I don't want to give tax advice. I'm going to be a real downer here and give you really disappointing answers, because it does depend a little bit. Yeah, I don't want to call any particular countries out. I'd rather get into specifics of their situation, of where they may be. There are some low tax environments we know, and it depends on how you enter a country as well. There are some tax advantages potentially for places like Portugal, but other places like Malta and Cyprus might be lower taxed. There is a trade-off between other benefits that you may or may not get relative to, say, living in Belgium, that may be a higher tax environment, but it would probably require some more specific than picking on any one country or presenting another.
I think I'm right in saying there are some countries that do include pension sort of tax benefits with the US. And off the top of my head, I think the UK, Joe, you may know more about this than me, and there are some that do and some that don't. And I guess that's a conversation with your tax advisor.
Yeah, absolutely. And there's also an overlay of quality of life. We've had this discussion with a few people, and you need to think, well, where is it most tax effective? But could I handle living there all the time? And again, I'm not going to pick on a country, but there might be some places that are a good tax environment, but not so satisfying for you, particularly to live in. So you need to get the balance right as well.
This is another one: potential tax on Roth IRAs. In general, is the potential tax on the total withdrawal, including principal, or just the gains?
So it depends how you draw it out. So and again, this is not tax advice. In general, from our experience, clients, for example, in countries like Germany, for example, may be subject to capital gains tax on the gains on a yearly basis in their annual tax returns within the Roth. Income, return of asset drawn down, depending on how it's drawn down, there may be capital gains from that drawdown. It may be return of capital, it may be income, and a good tax advisor can help you to save some money there potentially as well.
Here's a fairly specific question. I'm interested in hearing about PFIX and whether any assurance fee products in French banks are or aren't PFIX. But if they are they still worthwhile investments for both return and inheritance tax avoidance? Right.
Yeah, it's France gets really complicated in this context because the assurance V can provide some protection in itself because of its insurance structure. The underlying investments in them may or may not be PFIX, depending on how they're structured and what underlying investment, because you've got the insurance wrapper, then you have the underlying investments. So there's two tiers to that. So it can become really complex, and it depends on the nature of the underlying investments. If they're a standard managed fund, yeah, they're probably a PFIC, but they may have a QEF as a qualifying election fund to make sure they're not, or they may be in a different structure to avoid that as well. Or you may even have access to direct ETFs and things within that assurance fee.
Yeah, and here's another general one about retirement. When retired, when do you start transferring US investments proceeds to your country of residence if you've retired abroad?
Yeah. Well, partly that's driven by the US regulations in the 72, 73, for example, when you have to start drawing assets. And what you need and what your income needs are, you can do a number of things, I guess. A lot of people ask about, should I transfer my US pension asset into a European pension? Theoretically, you can potentially sometimes move a pension from one country to another. You then adopt the receiving country's liquidity, access, and so forth requirements. So often going from the US to a European country, you lose out on things like liquidity and access. So it's often not a good idea to do that. They may draw an income from the US and keep drawing it from the US. There is a currency overlay risk there potentially because you're drawing from USD to spend in euros. Or you may draw a larger lump sum out, transfer that, reinvest it. But again, you have potential tax implications there. It comes down to you on it. We have clients that do various combinations of all of these because it's dependent on their situation. Some of them just draw the income, some will move capital across. It depends on their situation.
Here's something that may be quite interesting. Does your company, and I guess it would apply to other companies, withhold taxes for individuals who are tax liable in one or more countries, such as US expats living in the EU, or do you simply provide information?
Typically, it'll be information provided. I mean, it depends on where you're invested. We don't hold clients' money directly. We recommend where it should be invested. So we're not holding the money. The clients always hold the money in their own name. But the investments they're held within may incur taxes within the investments, depending on where those assets are held. but they're not going to withhold it. They will generally provide things like a 1099, the tax report that they need to submit. They'll usually get them about this month, in fact, for the US reporting. And they'll present all the information of whatever tax has been withheld, capital gains, income generated, and so forth, so and validation of compliance, of which the 1099 is. So you'll get that sort of reporting to facilitate your tax returns.
It's a question relating to Canada. I'm not sure if you want to have a go at that. What investments are considered? Well, hold on, there are two parts, but the Canada part is, are GICs free from PFIC designation in Canada? A GIC is a guaranteed investment certificate, which is a type of Canadian investment,
right?
Similar to a certificate of deposit in the US, I think.
Yes, right, it is. And the short answer to that is I don't know. I don't know if they're considered PFICs by the IRS. I'm not sure. We can find out, but I'm not sure.
And then what investments?
If I can just extend that a bit, if it's a direct treasury bond or something like that, for example, like a treasury bill in the US, you'd have to run it through the definitions of a PFIC. Is it passively managed? P, passive. Is it foreign? Is it non-US? Is it an investment company managing it? And they're the general criteria, and that's the first I guess assessment of it.
There are a couple of similar questions here. One, I'll just read out both. What investments are considered non-PFIC overseas? And somebody else said, are ETFs less likely to be classed as PFICs? So I guess what are some investment options that don't run into PFIC reporting? Yeah,
so PFICs, or those that aren't PFICs, are funds who would otherwise be called a PFIC, but they've done what's called a qualified election fund, which means they've basically had to report on all their earnings, on all and all their members indeed, from their inception, or back done that to the US. There's very few that have done that. There are discretionary investment portfolios which can be European regulated and based, but have US under licensing, which makes them absolutely compliant, and therefore they're doing their onshore US reporting. That's a really nice way of getting around it because it's compliant. There's a number of different solutions around that, depending on currency, that make it rather simple and compliant. And they often contain lots of ETFs within them. And that's the way that we often address that with ETFs, because you do a couple of solutions, you keep the cost down really low, and at the same time you ensure US compliance. ETFs are interesting because the US and the EU have a completely different set of regulations on ETFs. And so no US ETFs are available in the EU because they're not compliant. They don't meet the MiFID, which is the EU regulatory standards requirement. So an institution like BlackRock, who own our shares, who if they want to issue an S&P 500 ETF, they'll have to replicate and create a Euro compliant replication of the one they have in the US. And then there's the question of is it a PFIC or is it not? And that will come down to a specific assessment that we do. We tend to not pick on specific ETFs, but use portfolio blends so that we can guarantee that they're not falling under the PFIC criteria.
That's great. I'm conscious of the time, but briefly, there are a couple of questions about your fees. Is that something they should email you directly? That's all.
They can contact me directly, but we're completely transparent on that. And I'll just tell you a couple of quick things without taking too much time. So we're a fee-for-service business. One of the nice things about being Dutch regulated is they have things like a commission ban. We're fee-for-service. We've got a fiduciary obligation, like in the US. We have to act in your best interest at all time. Sometimes that means telling you not to hire us. So what we typically do is 2 meetings to meet you, to get to understand you, but we don't charge for. And we have 2 criteria or 2 expectations for those meetings. One is, can we help you and can we add value? And 2 is, would you like us to? So if you want, we can organize a quick video call and a discussion, talk about your situation, see if we can help you. Then we can say, if we can, we work on an hourly rate typically, or then if it's cheaper, a flat rate fee for you. This is what it's going to cost. Is it worth it for you? Would you like to or not? And that way you know where you stand right from the start. And we put that in writing, of course. So we can do it that way. So if you want to get in contact, yeah, please feel free.
Well, I think we'd better wrap it up. We've gone over the hour. If you have further questions for David, the website is blackswancapital.eu. So feel free to reach out to David via the website. Thank you, David, very much for that excellent
Thank you.
presentation. And thank you to everyone who's joined us today.